day, everybody, and welcome to our podcast with David Rosenberg. It was many years ago that I first met Dave when he was one of the keynote speakers at what was called at the time the Malden Conferences, which were held every year, for probably 15 years or so. Great turnout of very individual and interested investors. And Dave always gave one of the most insightful and humorous presentations of the conference. So a little bit about David. David has spent his life as an economist, a number of years with Merrill Lynch, and then 10 years with Gluskin Sheff, and since 2019 on his own. David's firm provides all kinds of daily updates in economic analysis, market analysis. These are just some examples of the various newsletters and articles that are coming out from his firm every day. You'll also see him online a lot. This is an example, CNBC, recently in the Financial Post, an area that actually we should try to cover today. This only came out a couple of weeks ago about the implications in China and their slowdown. But most recently, Dave has been focusing on the recession that's coming or arguably might actually be here. And his newsletter, his newsletter from yesterday also reinforced a different view in terms of where we are with respect to inflation and what that might mean in terms of interest rates and by inference, of course, investments. I'd encourage any of you who are interested to subscribe to Dave's newsletters. You can get all the information you need at these links, which will be posted on our website as well, for subscriptions and for a 30-day free trial if you want. Now, with that in mind, Dave, thank you so much for joining us.
Well, thanks very much, John, for inviting me on and for such a gracious introduction. I'm truly humbled, and it's been many years since we last saw each other.
I know.
It's good to see you again. I don't know what anti-aging cream you're using, but you look terrific.
You know, these filters on these TV screens are really good. They're excellent. They can make you look like anything.
Well,
Yeah.
good on you, and it's an honor to be sitting here talking about the world view together. So I'm looking forward to this.
Well, thanks, Dave. Well, it is kind of an interesting time, almost, I think, in terms of a transition time. So maybe let's start with a big picture. So give us your general view from a macroeconomic perspective, big picture, like where you see us.
Sure. Well, look, I'm going to start off with what is still the most important driver of the global economy, which is the U.S.
Mm-hmm.
And it's obviously important for Canada since everything that is in Canada in the financial markets and in the economy is 95% correlated with the U.S. So people always say I'm U.S.-centric, but if you get the U.S. call, you're going to invariably get the Canadian call right as well. But we can get on the Canadian side as well. I think things in Canada, by the way, are in rougher shape than they are in the United States. But I guess my overall belief system is this. I believe that the business cycle has not been repealed. I believe that interest rates matter. And we just came off the most pernicious tightening cycle since 1981, and I'm sure people would remember that 1981 was followed by 1982, and we have a central bank chairman, Jay Powell, who has consistently compared himself to Jay Powell.
Right.
Not to McChesney Martin, not to Arthur Burns, not to William Miller. That's a good thing. Not to Greenspan, not to Bernanke, but to Paul Volcker. Well, Paul Volcker successfully crushed inflation by generating the conditions for back-to-back recessions. And so I think that the only thing that separated the expansion that we were in to the recession are just the policy lags. The soft landing everybody talks about is always the transition period from the expansion to the economic contraction. And those lags, as we know, are long and variable. But what's staring us in the face is not some new bull market or some new renewed economic reacceleration. What stares us in the face is the natural course of events, Mother Nature, and recessions follow expansions, and expansions follow recessions. So I believe the U.S. economy is going into an interest rate-led, credit contraction-led recession, already evident on the income side of the U.S. economy, not yet evident on the spending side of the economy, but the spending and the income will converge. And what we know about history is that gross domestic product, which everybody focuses on, is the one that converges on real GDI, which has been flat or negative in each of the past 3 quarters. That doesn't get much attention. So I think that's going to set the stage for a lot of other things. The renewal, which probably has already started, of the bear market, the fundamental bear market after the bear market rally. It's going to force the Fed to cut interest rates sooner rather than later, and by more than what the markets have priced in. And I'm not really too impressed with higher for longer. The same people selling you higher for longer were the same people 2 years ago selling you on transitory. So they say don't bet against the Fed, but there are some times when it doesn't hurt to do that. So my overall view, John, really is a natural course of events. Tight money, tight credit, recession, disinflation or deflation, lower interest rates, a bull market in treasuries, as investors get convinced that inflation will come down and stay down. That is still a debate. And that's also going to have implications for commodity prices. And what it tells me as investors, if you have a 12 to 24 month view, is to play it safe. This is not, there's a time and a place to hit a home run in a baseball game, and then there's a time and place to take a walk. So this is the time period to take a walk.
All right, so I mean, there are certainly a lot of people that also criticize Powell for the incredibly accommodating stance the Fed took leading up to the sort of this resurgence in inflation. So between quantitative easing and incredibly low interest rates, and setting aside the issue of you had to do something during COVID, at the end of it, would we have had a less severe counter response to what's actually gone on if the accommodations had not been so open in the first place?
Well, I think that that's 100% true. You had, in terms of that inflation bulge, I mean, we went in pretty short order, John, from 0% inflation to 9% in the summer of 2022. And there was a combination of very strong demand bumping against supply constraints that came from the COVID. It came from China's response to COVID, the disruption of global supply chains, of course, the Russian invasion of Ukraine. So ultimately, inflation, which is the general price level in the economy, like any price of anything, is going to be driven by the shape of the supply and demand curve and how those supply and demand curves are moving. So you're right, you had supply moving in an inflationary direction at a time when demand was shifting in an inflationary direction. And next thing you know, in short order, we're talking about 9% inflation. So I think that, the Fed had an accomplice, which was fiscal policy. So we had 2 rounds in early 2021 of these stimulus checks that people, you see, everybody need those stimulus checks. But, at that point, we weren't sure. We were, we already had the vaccines. Pfizer Monday was November 2020, but we kept on getting these variants, Delta, the Omicron, and are we ever going to get through this thing? We knew it wasn't the bubonic plague, but when will we get to finally, reopen the economy for good? So all those question marks. And so what happened actually, John, that's interesting was, Joe Biden said, go big or go home. So, $2.2 trillion of stimulus checks for all. The reason they did that was because there was all this historical research showing that when you give the American consumer a lot, we know American consumers, I mean, they love to spend. But history shows when they get stimulus checks, they would spend half and save half. I don't think anybody, so go big because they're going to save half, that's fine, but the government wanted people to spend, and so did the Fed. Like, we got to reflate the economy, get it back off the floor. But whoever thought that the Americans, God bless them, were the shoppers were going to spend every penny of it. They spent every penny of it. And that was really, when you spend that much money, yeah, and they couldn't spend it all at once. But, in the course of a 2-year period, $2.2 trillion gives you a big demand boost. And so that was
Right.
bumping for a period into the supply constraints. Supply constraints have been eased to a very large extent. The demand side has cooled off, and that's why the inflation's come down. It hasn't come down enough to make the Fed or the Bank of Canada completely happy right now. But I think the trend is in the right direction. But 100% that, with perfect hindsight, the reaction function by the Fed, and I would say by the federal government and Congress, would have been a lot different. The benefit of hindsight.
Yeah.
But it was a case of, damn the torpedoes, full steam ahead. And
Yeah.
if we had look, we finished off, look what everything was before COVID. Before COVID, we had 3.5% unemployment, right? We came off the Trump $1 trillion tax cut at a time of full employment
Yeah.
that everybody thought was going to generate huge inflation. Before COVID, you go to December 2019, before COVID reared its ugly head, unemployment's 3.5. Yeah, you have Donald Trump bragging about how every demographic group has got record low unemployment rates, and yet inflation was 2%, the funds rate was 2%, and the 10-year Treasury note yield was 2%, and that was a state of the world before COVID. And so that's what all these dislocations did in terms of the supply-demand dynamics. And they're subsiding, but probably it's still taking time to work their way through on the other side of the mountain.
So we had a Howard Marks on a couple of months ago, and he had written classical memo to clients that he writes on a regular basis
Yeah.
called Sea Change, and he had a view which he expressed on the podcast that yes, inflation had already turned. Yes, at some point there would be some impact on interest rates, but he thought there was a secular change here. Now he's coming at it from a fixed income strategist perspective. So he's seeing that the opportunities in fixed income, variable fixed income, and ultimately longer duration fixed income, if interest rates turn, would mean that we would not go back to that interest rate or inflation environment that we had experienced in the previous decade, pre 2020, and that we might be looking at a benchmark of 3%, and that interest rates won't go back down to 1 or 2 or 0%. So, do you see it differently than that, Dave? Do you see that that's maybe not going to be the outcome?
Well, it's situational. I don't think that central bankers, as a rule, really like to take their benchmark rate down to 0, 1%. But the conditions are going to warrant that one way or the other, whether it happens or not. If it doesn't happen, economic conditions suggested that we did not get back to 0 or 1%. But let me just say that I've heard that over and over and over the decades.
Mm-hmm.
And Howard, he's a brilliant guy, and I know him well, and he may end up being right. Look, when Bill Clinton got elected in the early '90s, as everybody was saying, Mr. Interventionist, big inflation.
Yeah.
Whoever thought, would you have predicted? And remember, the stock market sold off when Clinton got elected in '92.
Yeah.
But did anybody ever think that Bob Rubin would be his Treasury Secretary? Could you? Could we have predicted that, or could we have predicted that? George W. Bush, right, who got elected as almost a man of peace, and next thing you know, we're at war with Iraq.
Yeah, no, 100%, and even the surpluses that Clinton ran. I mean, there was a time there when people were actually predicting that the U.S. would basically amortize its entire debt.
Well, look, you could not have predicted that Bill Clinton would have been the one that would have deregulated, the telecom industry,
Mm-hmm.
or that he would have been the one to, make it tougher to unionize. Like, basically, the Clintons ultimately alienated the center left of the Democratic Party, which is why Barack Obama became president in 2008. And then back then, another big interventionist, big spender, And he did that for 2 years. He got Obamacare in for 2 years. And then we just had 6 years of fiscal tightening because ultimately Congress is the one that determines that. So, it's situational. So who knows? I would say that, you're taking a look at the past 3 decades and you look at the Fed. Did we know that, in 1993, we're going from 9 and 7/8 down to 3%? If you read anything from the Fed or anybody else in 1989, 90, that we're going to have a funds rate going from 9 and 7/8 down to 3, that was never going to happen. And then, back when we had the funds rate going from what, 6.5% down to 1% during the
Yeah.
tech wreck. If you told anybody that in 2003 the funds rate's going to be 1%, you would have been carried out in a gurney. If you told anybody during the housing boom of 2007 that we're going to go from 5.25 down to 0 with QE in the next 2 years, who would have believed it? And so it's what I'm trying to say is that uh, it would not be out of the realm of expectations that we do go back to the zero bound if what? What if we get a recession? And with all this leverage that's still out there and the hidden leverage, everybody says, well, look at the consumers. The consumer's not great because we know that auto and credit cards, and it's over $2 trillion combined. Mortgage market, that's fine. Lightning doesn't strike twice, but you have real significant pockets of excess. And so we get a recession, impairment of cash flow. We go back to a deflationary environment. Um, I got to tell you, we are not going to be hearing higher for longer anymore. So I'd say that, historically, and actually, we look at the averages and there's always dispersion. So I guess you want to look at the median, the mode, but let's look at the average. The average Fed tightening cycle historically sees the Fed cut rates 500 basis points when we have recessions. So I guess here's the other thing that we know. We know that this is where I might disagree with Howard, um, because the Fed's own estimate of the nominal neutral funds rate. Now, it's a hit or miss, right? This academic neutral interest rate, the interest rate when the economy is in equilibrium. But it's the best we've got. The New York Fed says that actually the pandemic and the response to the pandemic didn't influence the level of the neutral rate, but John Williams says that the risk is that it's going to be moving down over time. But right now it's 2.5%. The funds rate's 5.5%. So I'm there saying, I guess my response to Howard would be, well, look, just to get to neutral, look how excessively tight policy is. You look at the duration, the dispersion, the depth of the yield curve inversion, negative 4% money supply growth, the strong US dollar. You look at all these things. Monetary policy is extremely tight. Look at where real interest rates are. Monetary policy is inordinately tight. Now, it's not as tight as was easy, back in 2020. But policy is as tight as it's been since the Volcker era. And that's what the Fed wanted. He kept on saying, we're going to keep at it. That's the title of Volcker's book. So it's funny that the question's asked because the biggest inflation dragon slayer of all time, who was Paul Volcker, was also the biggest interest rate slayer of all time once the inflation was licked.
Yeah, once it
So
turned.
I'd say that I'm not. Could we go back down to the zero bound or towards the zero bound? I think that we could and probably will. Will we stay there? I hope not. But that's what history teaches us. History teaches us to expect the Fed to overdo it in both directions. So I cannot believe that if we have a recession, the Fed's stopping at neutral at 2.5. If they're going to net ease policy, they're going to have to go below 2.5. Now, John, whether that means going to 2 or 1.5, it doesn't mean you're going to 0. But what I'm saying is that
Hmm.
for investors that like to look at Fed futures contracts or the swaps curve or how do I play the yield curve, I think rates, look, the reason why people buy my research is not bullish or bearish. It's about who do you trust to identify and understand tail risk? Who is going to be able to identify what is not priced in? And I don't think that enough rate cuts are priced in for next year, the year after that. And you don't have to go to zero to have that view.
So you actually think this could run over a couple of years? And let's say I'm converting your thinking into either a personal financial strategy or an investment strategy. Okay, so two things come to mind. Number one, if I have a variable rate mortgage or if I have a fixed rate mortgage that's due in the next 12 months, this market that you're describing would tell me that I would stay variable
Yeah.
until such time as I would be back to a whole different universe of fixed rates, at which point it would then be time to change. So that would be one thing. And
Yeah.
presumably it means to the degree that I'm lending on a variable basis or investing on a variable basis now, that I want to increase my duration. And that would be primarily in the bond market. So that would be correct?
I would agree with that. Well, more forcefully on the first point that you want to actually, if you're getting in the housing market now, variable rate mortgages is what you want to be in at the peak in rates. The time to have locked in would have been a few years ago when rates were
Yeah.
at their lows. So it's a matter of timing. I did this analysis back many years ago when I was at the Bank of Nova Scotia, looking at any given point in time, uh, you have an 85% chance of saving more money, funding your mortgage short than taking out the 5-year term.
Right. Yeah. No, I'm not independent of that. I've done a study of the same myself. And I always, when I did have a mortgage, always went short term.
Yeah, you have to write out the cycles, but you see the banks make a lot of money off that mortgage curve, and
Yeah.
it's easy to play off of people's caution. I want to, my son just bought a home in Toronto. He
Hmm.
just got married, bought a home, and he asked me the same question. Both him and his wife, I think that his in-laws might have had different, but he asked me, Dad, what should I do? And I said variable rate. So what does he do? What does he do? He goes and gets a 3-year term. I go, oh no.
Well, but it's the kind of solution that an actuary from an insurance company would pick on the basis that you need to hedge your bets, right?
Well, it's a look. This is always a case of your assumptions drive your conclusions. So my
Yeah.
macro assumptions drive me to a conclusion that rates are going to be a lot lower. So why don't you wait and then lock in the 3-year term next year? But that's in terms of the other question on the bond market. Look, I am bullish on treasuries. I do understand that there's exogenous risks out there. There's things that are happening. Um, like even very recently, bad liquidity, uh, the Bank of Japan. Like the
Yeah.
thing is that all these markets are correlated. So, I could be right on my recession call. I could be right on my disinflation deflation call. I could be right on a lot of things. But what if at the same time, the Bank of Japan gets fed up with 4% inflation? They begin to play catch up and they begin to actually raise rates, or they continue to tinker with curve control, and then that's a mechanism that gets transmitted around the world. These are, you see, you always have to challenge your view. Now, to me, that wouldn't create a secular move in bond yields. I know everybody likes to talk about. It always depends on the thickness of your pencil. That the long-term secular bull market is over, right, John? It depends on your ruler and the thickness of your pencil. So
No. Well, I mean, maybe also the fact is the yield curve is inverted, has been for whatever, 16 months. And it begs the question that if you're going long duration, do you wait until it stopped being inverted before you make that call?
well, I don't know if that's really the case. I think that it's a matter of, what is your view? Like ultimately the correlation, let's talk about the 10-year treasury note. If you want to try true correlation, and we understand there's other risks out there. I don't think there's fiscal risks. I don't buy into this view. The U.S. gets downgraded to double A plus. I mean, to me that's noise. The U.S. is not default risk. The reserve currency is not default risk. I sometimes have to shake people upside down.
Yeah.
Um, there's going to be noise. Like what I tell you about the Bank of Japan, there's noise there, the liquidity. But I think that ultimately, if you're looking at what is the fundamental trend in bond yields, will follow the trend in nominal GDP. So if I have a recession coupled with deflation, I mean, we could have nominal GDP, in my opinion, is going to be, probably could be heading down to zero. It might even go negative. And I know that's going to catch a lot of people by surprise, but this is what happened in 2009. And if you told anybody when oil prices were $150 a barrel in the summer of 2008 and inflation was almost 6%, what was going to happen, in the next 12 months? So I think that I wouldn't mind. I mean, when bond yields are going up, I'm telling my clients, these are price dips in treasuries that I want to buy. I want to buy at this stage. So I don't know if I want to wait for the curve to begin to go to a positive slope, because the question is what's going to cause the positive slope. The positive slope is not going to be caused by short-term rates going up, because the Fed is done. I think the Fed is done. The Bank of Canada is done. The Reserve Bank of Australia, we saw this week, they're done. They're all done. They're all done. The Bank of Japan, I mean, who knows? But if we're going into a global disinflation, inflation in Japan won't stay at 4% for very long. And my worries about where I'm going to be wrong on my forecast, which is the BOJ, maybe I don't really have to worry about that. But you see, if you're telling me that you want to wait till the curve goes to a positive slope, I think that I'd want to start actually buying right now.
Right. So you would inventory a position. So there's two decisions that you have to make from an asset allocation perspective. The first is generally in this environment, and I'm reading between the lines about what you're saying, Dave, that if anything is going to get hammered, it's going to be equities as opposed to, let's say, fixed income. So any reasonable person would be looking to have a change in their general allocation to fixed income over equities. And then secondly, that they would lengthen their duration, and starting now would not be too early. Is that a fair summary?
Yeah, exactly. The major point is that the curve, look, the yield curve is only inverted historically 15% of the time. And, anybody, any CFA or anybody who's done any, you know, discounted cash flow analysis knows about the time value of money. Long-term rates being below short-term rates is completely abnormal, but this has
Right.
been what's
Right.
happened in the past 12 months, even longer, more like 14 months. This is not normal. The yield curve is going to mean revert. It's going to pull a Bob Farrell rule number one, mean reversion, and so how will it mean revert? It'll mean revert. Uh, right now, we continue to test the high end of the range on the 10-year Treasury note yield. We're not breaking out of that range.
Mm-hmm.
But I think the higher for longer narrative has been the principal thorn in the side of the longer end of the curve. Because the longer end of the curve wants the Fed to cut rates, priced moderately for rate cuts next year. But there was a time a few months ago it was priced for a lot more and earlier. There was a time a few months ago when the 10-year Treasury note yield was 375, and it was expecting the Fed to take the cost to carry down by the end of this year. Well, that's been priced out because of all the Fed rhetoric. So what you want to see happen, so the curve will move to a positive slope once short-term rates begin to come down, and they're going to come down not by magic, but because the Fed moves from we're tight to pause to then cut, and that's always the sequence. And then when they start to cut, the front end's going to rally a lot. Now, I think you could have a laddered approach in the Treasury market. You're going to have the two-year note yield, I think, down. I mean, my view is we're going to have the two-year note down to 2%, and you'll have you'll have 10 years down towards 3%.
Right. So, and in terms of an investment return, just for the benefit of the viewers that are watching this, if that occurred over the next, let's say, 18 months, effectively, you would pick up whatever, a 4.25% yield on the 10-year, and probably from a pricing perspective, something in the range of 12 to 15%.
Yeah, you be getting it. So that's what makes the long duration call, under the proviso that my macro call is right, more appealing, is because the convexity and the total return is going to be a lot greater. Even though the yield decline will be more pronounced at the front end of the curve, you're going to make more money at the long end. Now, just like, my son takes out a 3-year, a 3-year mortgage, just, right down the middle. So look,
Yeah,
the
you
one thing
could have an interesting issue with Because at the same time, you're looking at the alternative, which of course is traditional portfolios, either equities or fixed income. So from this point in the markets, especially when you're talking about the S&P 500, you could be looking at easily a 20% correction or bear market. And in which case, we're now talking about a return gap of 30 to 40% over a period of 18 months. Does that sound possibly reasonable?
Yeah, absolutely. Well, once again, we have to believe in Mother Nature, and part of that is the laws of mean reversion. And if you look at the total return index, the S&P 500 versus the 10-year note, it's like that move. That move in the past couple of years has been like a forced standard deviation event. So I think that just based on that alone, but based more on fundamentals, um, the point I made before, you can have a laddered bond curve and play it safe. I think that I would be willing to take on a little more risk in the treasury market and add duration.
And go along
Again,
the
that's premised. You have to believe in a macro view to stomach that duration risk. I'm willing to do that. In terms of the equity market, 100, your view on the equity market is 100%. The decline might be even greater than 20%.
yeah, no, it
And
could
I'll
be.
tell you, why. It's once again, we have to believe in fundamental math. And that therefore means the equity risk premium. We have to look at that trade-off between the yield in the bond market and the yield or the earnings yield in the equity market. Now, the equity risk premium is down to less than 100 basis points. But we know that that is a completely unappealing trade-off between stocks and bonds. And the mean reversion is going to have to take that to 300 or 400 basis points. 400 basis points is usually you get to at a fundamental low in the stock market. And this is what I mean, that I want to be bullish on bonds ahead of being bullish on stocks. The question is, what is the combination of the 10-year Treasury note yield and the S&P 500 that finally brings the two asset classes into a better balance in terms of expected returns and in terms of their respective relative yields? Well, it's basically, you're talking 3,200 on the S&P, which we're 4,400. That's, you're talking more like 30%, and coupled with a 2.5 to 3% 10-year Treasury note yield. And that's what I'm trying to tell my friends, my clients, my colleagues, that to turn fundamentally bullish, this year has been a classic, not just the fact that it's concentrated in 7 stocks. It was a classic counter trend rally in the stock market. This happens in every bear market, and it was tremendous, but some of the biggest stock sell-offs of all time took place during the Great Recession. You get these wild spasms on euphoria and animal spirits off of oversold lows, which is where we were in October of last year, but really that's all it is. So I think that we're going to have bond yields going lower, and the stock market is going to need those lower bond yields to reestablish better relative valuations in the stock market right now. I would just say the equity risk premium, if you're a long only equities, unfortunately, it is not your friend right now.
Yeah, but on the other hand, I think it would be safe to say, like, we just wrote a newsletter about this, which will come out in the next few days, about if you separate the S&P 500, as you point out, from the Magnificent Seven, stocks that are highly focused on technology and AI, and then take a look at, say, either the equal weighted S&P 500, the New York Stock Exchange, the Russell 2000, the FTSE 100, even the TSX. Basically, everybody else is treading water and has been all year long. So when you look at let's say, the other markets from their perspective, where they have not continued to accelerate their valuations, would you expect then, even if there is a correction or a bear market, it being notably more modest than it might be in the S&P 500?
Yeah, in fact, as far as Canada is concerned, we wrote a report on that recently, where I think the TSX now is trading at a forward multiple of 13, and in the U.S. it's over 19. And that's, I love to look at standard deviation events. This is a 2SD. So Canada, there's no get out of jail free card for any stock market in a global recession. However, I think that there's a greater valuation cushion in the Canadian market than there is in the U.S. market. Fully agree with that. And actually, you can pick apart parts of Asia, including China, where there is much more valuation support. Because really, what creates those conditions for 30% drawdown in the stock market historically is a combination of the earnings decline and the impact from the contraction you get in the multiple. So we're going to get an earnings hit, and it's already started, around the world. But the multiple contraction will be more acute in the United States, and that's where the vulnerability is.
And yes, so let's segue in. Let's segue into China because China has gone, and so this is why I'm trying to separate what's economic versus what is arguably inevitable, the reshoring or nearshoring aspect, which is what is geopolitical. I mean, their economy is classically underperforming on all kinds of fronts, some of which is structural related to their decision about how they want to run their economy as being investment driven as opposed to consumption driven. But the fact is they're in a period now where they've already entered a deflationary cycle, especially from a production perspective. So is this again the canary in the coal mine? Is that what we're looking at here is a representation of what will be manifested elsewhere?
Well, it's China right now, in some sense, is almost the mirror image of what the U.S. was, back in '07, in '08, coming off a major property bubble, massive concentration of the economy in the real estate market, um, household savings being plowed into these trust funds that then invest in real estate, and so that bubble is popped, and now China is going through a deleveraging cycle. Now everybody's, if they cut loan, deposit ratios, or they modestly cut lending rates. It's like what the Fed was doing. Everybody got excited with the Fed cutting rates in the summer of '07, but it wasn't a liquidity crisis that could be solved by interest rates, as we found out in the United States in the Great Recession. It was a solvency crisis, and I think that is exactly what we have. And you could see it, the fact that the property sector in China is a mess. There are mounting defaults, and the problem with China is, as sophisticated as they are, not having been a capitalist, eat what you kill, creative destruction economy like the United States, they don't really have the knowledge or the capacity to how to clean up this mess. The United States knows how to do it, and really it was classic. The first was RTC back in the early '90s in terms of cleaning up the regional banking mess. The U.S. knows one thing: the U.S. knows how to create a crisis, but it knows how to clean it up.
Yeah, I mean, it lets prices go. I am surprised that the Chinese, when it came to housing, made a decision to actually artificially support housing prices by local governments essentially limiting what the transactions could take place at. So the fall in the house price in a particular jurisdiction could only be 1 or 2 or 3% lower than it was a year before, as opposed to whatever the market would decide.
Well, you see, from Beijing's perspective, housing produces wealth, wealth produces confidence, and I think that the superior way of achieving more of a consumer spending profile in China was and remains providing a social safety net, and they've never done that. So their savings rate is sky high. They don't have a real consumer society. But the difference is, of course, is that people talked about global decoupling. China, the economic superpower, the commodity super cycle. I'm talking about, back in 2007, 2008, and we saw where that went. But America is the consumer to the world. China is not the consumer to the world; it's more the producer. But it's still basically still very important. So this isn't as big as what happened with the U.S. back in the great financial crisis, but this is something that is going to have reverberating impacts. It's the world's second largest economy, and this is not a typical cyclical slowdown. I saw the canary in the coal mine when they finally did their full scale reopening. We had 2 months of good data, and then we just rolled over. So they have too much debt, They have deflating assets, especially in the real estate market. I mean, we've seen what this is like in other countries, right? How this plays out. And they have terrible demographics. So they're in a true structural economic slowdown that's now bumping against the cyclical recessionary pressures. And this is going to mean that, this is in the context of what Powell's already done and negative money supply growth in the United States. Export prices, Chinese export prices are down 5.5% year over year. And their export prices is somebody else's import prices. So China's already exporting its deflation around the world. And so that's why, again, I'm bullish on treasuries. It's not things people are talking about, but what's happening in China, I don't think it's going to create the conditions for a global financial crisis on the scale of what happened in 08 or 09, but that doesn't matter to me. At the margin, this is still a very important economic and financial event, and it leads towards one conclusion, which is a deflationary or disinflationary conclusion for the global economy. That's where I fall out.
Yeah, so wouldn't that potentially slow down this so-called, well, combination of decoupling, nearshoring, reshoring, so basically people moving production away from China, given that if you're in China now and you've already got these sunk costs, you're going to do whatever you need to do that even from a pricing perspective, would that slow down companies who would now find it lower cost to continue to deal with and bring in goods, finished goods from China?
Well, I'm not sure. I'm not sure about that. There's the regulatory crackdown, question marks over China and Taiwan. I mean, you've got a lot of concerns, and Xi Jinping's becoming a one-man show to perpetuity. I'm not. What's happening is that investment, and this again is part of the structural slowdown, and keeping in mind that China's been put in the penalty box.
Oh
We
yeah.
were talking before about what does the world look like without Russia part of the global political order, and what does China look like without being a part of the global economic order? And now all sorts of restrictions, constraints on what China can do, what investors in the U.S. can do in China, and this is turning global. So the screws are being applied, and a lot of that is because, I mean, China in this respect became victim of its own success because when it came to the 5G technology and all the advancements, I mean, they were at the cutting edge, and so we have to play catch up. And look, we know as Canadians that Americans know how to play hardball. Anybody that was involved in those free trade negotiations in the late 1980s knows the U.S. will always do what's in its best interest, its self-interest. And right now it is, you know, doesn't want to escalate this economic Cold War that we've been in, but it has entered into a new chapter. But that's something else to consider in China is part of the structural slowdown is the impact all this has had on direct investment in China. But what's happening is that investment that would have ordinarily happened in China is now going to other places. And one of the beneficiaries has been Japan.
Yeah, interestingly.
So Japan's economy is doing just fine in the context of its own horrible demographics, but real per capita GDP growth in China is one of the best in the world. And their stock markets, everybody's focusing on the Nasdaq 100 and focusing on the S&P. Japan's one of the best places to invest this year. But they're getting, so that's investment in their equity market, but the direct investment flows. It's funny that one of the beneficiaries actually, and it's interesting since China and Japan in the past number of years have become a lot closer after decades of a frosty relationship. China has emerged as a big beneficiary from what's happening in China. But I'm getting a sense that you are seeing direct investment outflows from China at other parts of the world, and that's part of your onshoring, reshoring, and part of that as well is that nobody can trust China anymore when it comes to um, protecting global supply chains. I mean, what are you going to do if let's say, will we have another pandemic? I mean, I don't know, but chances are that the way that humanity goes, yeah, we're going to have another pandemic. Hopefully, it's not going to be as bad as COVID-19. We've had other pandemics that weren't that, that weren't that bad. However, that was one of the things that happened globally was God forbid, you get 5 cases in a port city in China of 30 million people and you're locked down. So I think that it's become less of a reliable source. Of all the countries in the world, China emerged, and this is beyond everything else. The economic war with the United States, what's happening, of course, in their property market, their debt defaults, that China as an entrepot for direct investment from other countries, um, a lot of second guessing just because of their approach to COVID last year.
Yeah, but rule of law and stability from a political perspective, even a policy perspective, makes it a bit of a challenge. You're starting to look at somebody making a commitment, let's say, especially in manufacturing, to build infrastructure that, in theory, you expect to have a 40-year life expectancy or longer, and you've got something that might change ideologically in 18 months, right? So why would you make that commitment, basically?
To just 100% right. Just there's just too much uncertainty, and there are viable alternatives. And it's not even as if look, it's not even as if that China has not been the world's low cost center for manufacturing for many years. And of course, it was a decade ago. People were saying, well, they're aging and their population is going down, their labor force is going down, their labor force is shrinking. It's going to be inflationary. We're going to get wages going up, and that all happened. And so, what do companies do? They diversified their facilities into Bangladesh and into Vietnam, and now they're moving into Japan and into Mexico. China stopped being a low cost producer a long time ago. Yeah, there's other avenues if you want to service that part of the world. There's other jurisdictions that can help feed that.
So bringing back to Canada, and maybe talking about housing a little bit. So obviously, there's been a bit of a surprise. There's a bit of weakening over the last couple of months, but basically a little bit of a surprise given the rise in interest rates in the last 12 months about how sustained prices have been, specifically in Vancouver and Toronto. And some argument about whether that's immigration driven or whatever policy might be impacting it. But if you're talking to, say, coming back to our clients about what the expectation should be for housing, do you have a feel for, especially for those key markets, Toronto, Vancouver, what is the likelihood of the combination of things we're talking about? I mean, lower interest rates would help, but not if there's a recession that's actually sucking up cash flow.
We have a huge housing bubble. We have a price bubble of unprecedented proportions. This is a bigger price bubble in residential real estate in Toronto, and I would say, broadly speaking, South Central Ontario and in Vancouver. That was bigger than we had in the late '80s.
Yeah, I
That
remember that one.
consumed John Crow's attention. I come back once again to my hero and my mentor, Bob Farrell, on rule number one on mean reversion. And I'm looking at two standard deviation events yet again. And it's not just, and it's global, by the way. This is not just in Canada. This is global. The same in the United States. Although the housing affordability ratio is much worse here than it is there. It's one of the worst in the world. And I think that the immigration, because of course, birth rates and multi-decade lows in Canada, fertility rates, our natural population growth is next to nothing. So all the population growth is coming through immigration. But you see, when you have kids, you got to get diapers and a crib and baby food, but you don't have to buy a residential housing unit or rent one. But what we're doing is we are supplanting declining fertility rates and birth rates with this immigration boom, and people come in and they have to have a roof over their head right away. Either they rent or either they buy, and so it's created that's one of the critical things beyond the demand aspect of what's going on right now. There's other things that more local levels of government could do on the supply side, but and how much speculation there was. And we got to go back a couple of years. Nobody talks about it anymore, but all the Canadians, especially in Toronto, that were buying second properties on leverage. Once again, we were going through this whole
Right. Yeah.
greater fools theory, and so there was a lot of speculation in the price as well by homegrown residents, not just people that are moving in from other parts of the world.
Well, yeah, but they could buy with a HELOC at effectively less than 1% floating rate. So basically, what was the downside? That psychologically, basically the cash flow you need to support that HELOC is next to nothing.
Yeah, and look what's happened. Look what the banks came out and told us uh, everything they've been doing to keep homeowners afloat who are on variable rate. They're all like upside down on their mortgages. It's just a mess. I never thought home prices. I mean, John, the average price, even with the price dip in the past few months, and it's been a dip, the average home price in the Greater Toronto Area is 1.2 million,
Yeah,
and the average family income is like is just over 100,000.
yeah, it's a big
I mean,
multiple.
think and then think of where interest rates are. It's not like you're doing some discounted cash flow analysis on zero rates. Zero rates, discounted cash flows, everything goes to the moon. We saw what everything did back in early 2020. But I say that when I look at the affordability ratio, which is basically three variables, it's the home price, it's income, it's interest rates, uh, is 30% more stretched than the historical norm. Home prices would, if we don't get help from interest rates, home prices to mean revert, and let's just assume that incomes are constant, home prices will go down 30%. Now, I'm not saying they're going to go down 30%. I'm just talking about the math. Hopefully, we'll get help from lower rates, but the affordability ratio does not stay constant, and it is a two standard deviation. And so I would say that home prices, there's a day of reckoning that's going to happen with home prices across the country. Now, of course, the biggest bubbles are in your neck of the woods and my neck of the woods, and but I think that we haven't seen all the lags from what the Bank of Canada's already done, and now that the banks are being forced to dramatically raise their loan loss provisioning, there's going to be a credit contraction. Credit availability will not be there. The what's really what we used to call on Wall Street extend and pretend. That's what was happening to keep these homeowners afloat. We know now that's not going to be happening in the next year. So everybody who's been saying, where were these weak hands? All these people that took out like variable rate mortgages at high loan of value that could barely afford. What happened to these people that took out these short-term mortgages and then rates back up and then nothing happens? But the thing is that the banks were doing the extend and pretend. But now that Energizer Bunny is run out. I think the next 12 months you're going to see a lot of weak hands. A lot of weak hands have to turn over their homes. And that's what's happened. I'd say the most important thing in the Toronto market, John, in the past 5 months, listings are going up.
Yeah, so they haven't been. They haven't been. They've been stalled. The listings, I mean, have been stalled, but they seem to be. It's like you just sort of waiting for. It's what was the? It's the Minsky moment. It's like you're waiting for that one extra snowflake to drive the avalanche down the mountain, and it just feels like just waiting for this event to
Yeah,
unfold.
and look, it's going to so the supply is coming back. Prices are starting to edge lower. A lot of momentum in both directions. I think the momentum and home price are going to be down. It's going to create winners and losers. So people who are extremely leveraged that find themselves upside down on their mortgage have to then, make the calculation. Do I want to stay here? I got negative equity in my house. What do I
Oh
do?
yeah,
Doesn't make financial sense. And so things are going to change. But, on the other hand, people that, I have one son who's a homeowner, but I have another son who's looking for a home. So one son's not going to be too pleased. One son is going to be licking his chops. So,
no, no, you're right, exactly right. Well, in theory, I mean, again, following basically your prognostications, at the end of the day, for your son who doesn't have a home, from his perspective, he wants to buy a home with the highest unemployment rate, the deepest part of the recession,
that's
and
right.
as a result of that, the lowest interest rates that he's seen in years. So he needs this combination, which, based
Y-
on what we're
Right.
talking about today, would be about a year and a half from now,
Hun-
and they should basically be just saving like crazy between now and
100,
then.
100%. Well, I think that so this son is my COO. He's Jacob. So
Wait, tell
hopefully
Jacob that's what I think he should do
okay.
anyway.
Well, he's going to watch this program. So I hope this one listens to me. Although I don't know what his in-laws are going to say. So I only have I might be the economist, but I only have one voice.
Yeah, I always find it really weird that countries like Germany have ratios of up to 50% of people who rent forever. Like their view of housing is not to own it, which has had a
Mm.
huge impact on the lack of increase of housing prices for like decades in Germany. I mean, it's not just population, there is that as well, of course, but the reality is that it's a completely different mental view of the importance of home ownership.
Yeah, I don't know how fiscal policy plays out there. It's a different mentality there. Um, but don't forget, like in the U.S., mortgage interest deductibility,
Oh,
like right
yeah.
there, and then in Canada, no capital gains tax on your principal residence.
Yeah, that's a plus. Yeah.
So yeah, so it's always been well because there's this view the home, it's the American dream, it's the dream of a home ownership, and all these studies done in the 1960s, when the liberals were in power into the 70s, that home ownership makes better citizens, which by the way has been totally debunked, right?
Even the post-war thing, like the whole, the image of, you'd buy in the burbs and you'd have a nice car and you'd basically commute and there would be like I mean, all every from Leave It to Beaver to Father Knows Best, there was these models and about how you were going to live your life, and so yeah, I can understand why millions of people say, well, when I'm there, I've basically bought the dream, right?
Well, the thing is that back in those periods, your home was a place that you raised your family. You lived in
Yeah,
your home. You didn't think. I mean, your home was your asset, but you
yeah.
didn't think about it as your asset. You didn't, borrow money against that particular asset. You didn't treat your house.
No, you paid it off and then it was done.
You didn't
Yeah,
treat your house like it was your equity portfolio. And I think
yeah.
that's what's changed a lot is how people
And
view.
people didn't talk at parties about how much their home was actually worth and stuff like that. You're right. So listen, I have one more question for you because we are running a little out of time here. Um, if I were to ask you what your asset allocation would be on a go forward basis, what would you be telling us?
Wow. Well, it's so hard to do that today where you've also got alternative assets. So I don't have a so I have some assets, and of course this is something that you specialize in, but I do have some private assets that are not correlated with the stock market, but it's a
Right.
relatively small share. So let's just talk about. Um, I probably have John in the company and personally in the holistic, say Rosenberg asset mix, the lowest equity exposure I've had since 2007, and I would reckon it's probably around 15%. And I want to reach a point in the next 12 24 months where that's going to be taken up to 50%. But I have to see the math. I have to see the math work in my favor. I'd say that I I've been buying quite a bit of gold, and I'm buying gold coins and storing them at the uh, at the uh, at the Royal Mint in Ottawa. So without getting into, maybe I've got it's a building portfolio, but say 5% in gold. I'd say fixed income of all sorts, and you talked about our friend Howard Marks, who's of course very bullish on corporate credit. And you want to invest with guys that can really do that right. And he believes that credit will provide equity-like returns without taking the equity risk. He's probably right. So a large contingent in in uh, large contingent, right there as well in terms of the overall fixed income. But I'm definitely overweight. I'm definitely overweight fixed income. And don't forget, part of that fixed income is is I'm also in long short credit. I want to be in long short credit because I want to be in active managers that will know how to play a cycle of spread widening. So and that works in both directions. So I've also got money in some reputable hedge funds, but not market neutral. Like I want fund managers that know how to short the market. The most important thing about hedge funds in equity land are understanding managers who know how to short, which takes a real skill. So it's hard to say. Let me just say that my public equity, let's just say my public equity exposure is around 15%. And it's a hodgepodge of other things, but I'm really right now focusing on what is the all-in yield of my portfolio, what is the cash flow yield it's generating, and what's the beta of the portfolio. And that's really what I'm focusing on the most. It's been de-risked a lot. And actually, when I say 15%, I have been, I'm not buying any dips in the equity market. I've sold the rip, and if I'm buying dips in prices, it's in bonds and it's in gold. Actually, that is my mantra, because I love alliterations, is the bond bullion barbell.
Got it. Okay, so any last thoughts you want to share with our audience, our clients?
Yeah, look, I would just say with the benefit of almost 40 years of experience, the two things that I've learned the most is that there is no such thing as a sure thing. So I talk a lot about tail risks, um, and that's very important. Um, but we have to always look at our blind spots. I do that constantly. There's no room at all for arrogance or being stubborn in this business. So you have to be very disciplined. So there's no such thing as a sure thing. And that also means always watch your blind spots. Where am I going to be wrong? We should all do that. And don't put all your eggs in one basket. I do believe in having concentrated bets, but not a one trick pony. You've got to have
Yeah,
some
fair enough.
diversification. I still believe in that.
As do we. Well, listen, Dave, this has been great as usual, and it's extremely timely as well. So we're looking forward to sharing this with a large group of people, and I'll be out in Toronto, I know, before the end of October. So hopefully we can reconnect in person. I look forward to seeing you then.
That'd be wonderful. You could share some of that anti-aging cream with me.
Yeah, well, let me see if I can find it.